All right, guys, welcome back to the channel, your number one source for income-oriented investing. I got a special guest today, returning champion. It's been a while, but you're finally back, Nawan from Purpose. Thanks so much for coming back, Nawan. How's it going, my friend? How you been?
It goes really well, and things at Purpose are doing really well. I know you've had my colleague Nick on the channel as well. Some very interesting income products that we've come up with over the past
Yeah.
couple of years. I'm happy to be here chatting about our Bitcoin and crypto yield products again with you. So hopefully we can get the investors what they want.
Yeah, for sure. So I will have some tough questions for you, but these are all, questions that you'll probably expect from the audience that I've received. And I have a couple myself. So obviously this is the income channel. We're going to focus a little bit more on the covered call crypto ETFs, but I also want to talk to you about other stuff as well. So I'm talking to my audience here. In case you didn't know, Nawan is pretty much, I think you're the head portfolio manager of like the Bitcoin and the Bitcoin covered call ETFs and the Ether and the Ether covered call ETFs. Is that, head portfolio manager, that right? Or maybe one of the portfolio managers?
Yeah, I think head portfolio manager is a little bit of a stretch here, but absolutely, I'm a portfolio manager here involved with all the systematic option writing strategies. So I help Nick with his yield shares products as well. So anything to do with covered calls and option writing at Purpose, I'm fairly involved.
Yeah, I had Nick the last couple of times to talk about the yield shares as well. So it was a great help. So yeah, super happy to have you on. Let's start with something pretty crazy. I think I just saw it today. It was so ironic that hey, I'm talking to Nawan today, and I see this post here. You guys are pretty much celebrating a 3-year anniversary for your spot Bitcoin ETF, which literally was the first spot Bitcoin ETF in the world, right? The US,
Yeah,
just we'll talk about the US launches, but
yeah.
Canada was way, for once. For once it was great, way ahead of the US on this. So tell me a little bit how what a crazy thing, a 3-year anniversary on the first spot Bitcoin ETF. What are your thoughts on it, just in general?
Yeah, absolutely. So what I'd say is, it's not just that we're celebrating. I think
Right. Yeah.
all Canadian investors as a whole are celebrating. It's something. Digital assets are very interesting. Digital assets really provide this and new form of investing that is a little murky and vague at times, but it's about institutionalizing that murkiness, that vagueness. It's about bringing it to safe sources, making sure that investors are always comfortable and confident in what they hold and the returns that they can get through those holdings as well. At the same time, making sure that there's no potential hack or potential loss of wealth that's defined by these black swan right tail events that just sort of come out of nowhere. So that institutionalization is very important. We're quite proud of what we've been able to do within the space. It's been 3 years, and I'll tell you, there was a long journey before that, behind the scenes with the regulators, trying to make sure that we can get to market on such a product, getting everybody comfortable. And then more importantly, I think what we've been able to do is define the blueprint of how to bring digital assets to the market. We were followed by some of our peers up here in Canada. But if you take a look at the basic structure of what these spot Bitcoin ETFs in the US have been able to do, it's very much the structure that we pioneered. So we're quite proud of what we were able to bring up to the market, where we celebrate with all our investors as a whole, being able to give them access from Bitcoin at $18,000 to currently Bitcoin, I believe, we touched $52,000 US yesterday. So it's been quite a journey. As far as looking forward goes, I do think digital assets is a space where a lot of growth still persists. It's a space that we're still very curious about. We continue to learn about every day, and we continue to try and innovate and bring interesting new products to the market for our clients. The yield products was one example, but hopefully in the near future there will be more examples as well of where you see us just sort of like pushing the boundaries a little bit, working with the regulator and making Canada first in a whole bunch more things.
Yeah. Oh, I'm gonna ask you about some of that new stuff potentially coming later on. But I have to agree with you. And listen, I've been an early investor in the covered call one, and it's right what you said, because at times, especially in 2022, at some moments, it was really really scary, right? There was a lot of bankruptcies, a Gemini bankruptcies, and I have to admit, and I'll give you guys props. And by the way, this is not a sponsored video at all. You're taking the time just to do this on your own free time, not a sponsored video. But hey, you guys were really, really good at communicating. You have a lot of great articles when it comes to crypto on on Bitcoin on your website, and you were really good at communicating when there was that whole like Gemini bankruptcy. I can't even remember if that's the name. I think it was Gemini or
Yep.
something else. And I remember getting a lot of questions from my viewers that were worried, and nothing happened. Everything was perfect. Your ETF, like everything was secure, and this just I keep telling people like this is really an advantage of getting the ETF, making the professionals manage it. That's just another advantage. Yes, you're paying the fee, but trust me, the fee could be well worth it. So I mean, everything was smooth sailing, everything was great. Nothing happened on on BTCC and ETHH when there was those scary times in 2022, I believe it is.
Yeah,
So yeah,
there's a more than a few groups that had a very difficult time during that period.
yeah,
The big one was FTX at the point, and there's a lot of counterparties that if you don't know the space well enough, there's a lot of counterparties that you could deal with that could have been in cahoots or in bed with FTX at the point, which really leads to a deterioration of the quality of assets that the investors might hold. As far as our stance on this goes, we do think this is a new asset class and that we do need to spend our time educating our clients and our investors. And that's why you'll find lots of great articles on our
yeah,
website where what we're really trying to do is provide that value added service and make you comfortable with the asset class to make sure you know exactly how it works, because everybody talks about it. Bitcoin, Ethereum, it's all over the news, but nobody really will give you a very easy, digestible way to understand these assets or the safety or around these assets. And that's, we try and put our best foot forward. We try and give our investors as much information as possible. We are co-investors along, you as well. We believe in these products as well. And our goal is really to have investors realize that yes, we are pioneers in bringing the ETF assets to the space, and no, we might not be pioneers within the digital space itself with a whole bunch of major coins and altcoins and developing blockchains and coming up with those ideas. That credit is definitely due somewhere else, but to be able to translate that into a regulated space and
yeah.
then be able to educate the clients, I think that's a very important aspect of what we do.
Yeah, I mean, it is pretty hard to understand. Of course, if this is how I know I'm getting old, because if you talk to young people, it's like, oh yeah, I know exactly what they do when they could talk about it. Like, I could say that I pretty much understand Bitcoin, but like even Ethereum, I'm still like a bit hazy. But I guess it's because I'm getting old. But either way, you guys do a good job on those articles and educating. I mean, I think you have like a consultant or someone, especially in the Ethereum space. I had him on the channel. We talked about it for an hour. I understood it more, but some people watching that could even be more confused. So it is a bit more complicated. Bitcoin, I think, is the easiest. But anyway, we're not going to get into that today, unless we're going to spend another 3 hours. I really want to talk about the ETFs now and stuff like that.
Yeah.
So, as you know, it's a huge moment in the US. The SEC finally approved the ETFs. There's Fidelity, there's BlackRock. I think BlackRock's in the lead. What I want to ask you about, and here might be some hard questions coming up, and I know maybe you won't be able to answer them directly because there's a lot of regulation around this stuff. You can't really say what you're going to be doing in terms of fees and distributions. But I did notice right off the bat, the ones in the US, they have, I think the BlackRock one is 0.25% fee or 25 basis point fee, something along those lines, probably. And I'm talking about BTCC, I think is 1% fee. So what would you just say in general? I know that as soon as those ETFs were launched, it was a massive exodus of the Grayscale Trust, which had higher fees.
Mm-hmm.
Are you worried about that happening for BTCC? Because it is a 2 billion, it's like 2 billion AUM. It's pretty big. So what is Purpose's thoughts on fees and things like that?
Yeah, absolutely. And just upfront, there's limited
I understand.
information that I can put out there, and I'll try and answer the question to the best of my knowledge and what I can say as well. First of all, what we've seen in the U.S. is an awesome feat for the space.
Yeah.
It means that in addition to the Canadian regulators being ahead of time and approving a spot ETF, the SEC, which can be, defined as one of the golden standards in the world for securities regulation, has actually become comfortable with the space, which, even though we've seen some mixed messaging from Gary Gensler and the likes, but nonetheless, it really speaks to the popularity, the strength, and the robustness of the space as a whole. So I think it's a big vote of confidence for the space as a whole, and we're very excited of the new entrance into the space it brings, as well as the new competition in the space, because it means that the space is getting validated. Now, as far as the US goes, the launches go, I was quite impressed by the launches as well. We track the amount of assets in the space, and what we've seen is there's probably a net new somewhere around $6 billion US that have entered the space ever since the launch of the ETFs. And so this is, us tracking global ETFs, the futures ETFs that were launched earlier, BITO, I believe is the ticker on that one.
Yeah.
And then just taking a look at, the outflows from Grayscale and the inflows into the new Fidelity, BlackRock, ProShares products. The $6 billion is not a small amount, especially for a nascent asset class that is just starting its institutional journey. So it's very, very interesting what they've been able to do. The US is a different model than Canada has been as far as the ETF space goes. In the US, the space is slower to really innovate, but also they're much quicker in their race to the bottom. And we've seen this, Vanguard, Jack Bogle, that's the model that they came out with 20 plus years ago. And that's what they've been constantly doing is take these big popular ETF as loss leaders in their business so that their brand equity is built at the loss of what they're doing. So at 25 basis points, BlackRock, and waiving the fee for the first 6 months or like the first 5 billion, those sort of elements actually mean that BlackRock is going to be funding the expenses of that Bitcoin ETF from their pockets for a very long time. And for an organization as large as BlackRock, really a $5 billion ETF is it's a drop in the bucket for them. Now, when it actually comes to the quality of the product and the robustness of the product, that's really where the fees is able to justify itself. So 1% by no means in this new world is a cheap fee, if you could put it that way. But what it does is it defines the robust infrastructure and the cost of that infrastructure that has been created around making sure that the assets are going to be safe and liquid at all times. So if you take a look at the BTCC funds, they still offer some of the greatest liquidity in the space. They still offer some of the narrowest spreads. They trade very, very true to NAV. They're still one of the only funds, and in the US you can't do this, but they're one of the only funds that if you are an investor in size, you can actually buy them at NAV. In the US, this is not available, and therefore you'll see a lot of those products actually trade at premiums to NAV. So you pay just a little bit over what the actual value is. So it's interesting. I think there will be a lot of evolution within the space. I think there's probably around 15 players in the space right now. Those will consolidate down. There will probably be 6 to 8 major players that end up rounding the whole market, and that's where you'll see at the end of the day this sort of like race to the lowest fees. This will go away, and they'll sort of normalize their fee structures to actually start reflecting some of the custodial costs and the costs of a robust infrastructure, once they see it. Because I do think that is really the most important part of digital assets. It's not as plain vanilla as it might seem. It is quite robust, quite complicated and complex in the background. And we do think, the fees is very reflective of the quality of the product. And, going forward, I can't make any comments, but I hope that suffices as, how to justify the cost of the product right now.
Okay, sounds good. Perfect. Thanks for answering that. I know it was a hard question, but and you can't speculate further, but definitely appreciate your answer on that. So, my channel is all about income. So now I want to get into really what interests me personally, to be honest, and probably my audience members as well more. But I just wanted to talk about the BT, the spot because the covered call one. So I'm talking about BTCY, of course, for the
Mhm.
Bitcoin, ETHY for the Ether one. You guys are writing covered calls on your own spot Bitcoin ETF. So BTCY on BTCC, ETHY on ETHH. Now this is more like a personal question for me. Wouldn't it be better now to write the covered calls on like the BlackRock ETF in the US because it's probably going to be, I don't know about now yet, but most probably, the US options market is just like this compared to Canada. Would it make a difference? Are you thinking about that? Are you exploring that? Or it doesn't really matter on the ETF where it's listed or whatever because it's always going to be on Bitcoin price and Ether price? Hopefully, I'm asking the question in the right way, but I think you know what I'm trying to ask here.
Yeah, absolutely. And there's a lot of different ways I can answer that question. There's a lot of different things that I can dive into because there are many complexities related to that question as well. To start off with, I'm very excited that we have these US products now, which really are improving the liquidity profile of the options chains available on Bitcoin and Ether spot ETFs in North America as a whole. The introduction of those spot ETFs in the US means actually the liquidity profile in Canada is also improving.
Oh,
It,
okay,
it
okay, okay.
means, yeah, it also means that we have a lot more institutional players now getting more and more interested in taking the opposite position of our covered call writing as well. I am having many more conversations, many more incoming conversations with institutional brokerages that want to do more business with us just because the US coming up with this structure sort of validates the space as a whole. Everybody's
Yeah.
compliance department and risk departments are now signing off and a little bit more. And so there's more liquidity jumping into the space. So overall, it's a big positive. Now, as far as using the Canadian or our own version, or sorry, the Canadian listed options versus the US listed options goes, there's a few different things to consider. One is that the option, even though the price is connected to the underlying, the option has to always be fully covered, which means that if I'm writing an option on BTCC.B, I have to own those many shares of BTCC.B in my account. Otherwise, that option would be written for speculative purposes, which would make it offside for the regulatory aspects of an ETF, which is the format in which we make it available. So we must own the same underlying. Now, the question now becomes is, do I want to own IBIT and then write options on IBIT? And
Okay.
that's really where it comes in. Does it have a better liquidity profile? I think the liquidity profiles are very matchable as of right now.
Okay.
And then a few more things. One being that when we buy and hold BTCC.B within our own BTCY fund, we actually don't charge on the fee. So we rebate the fees into the fund because you can only charge fee once.
Right.
And so that way we make sure that it is the most efficient and that we're not paying an extra fee for holding somebody else's product.
That's true.
Right. So that's a big positive. And then there's one more thing I had in my mind, which was, yeah, I'd say overall the liquidity profiles are much more improved. We're getting sort of like very similar economics to what's happening in the US. There isn't really a big difference. And IBIT would introduce a FX cost into the fund because the underlying would then be in USD as well. That
Yeah.
creates another layer of costs to our clients, which we want to make sure that we minimize on. But other than that, it's a really positive thing for the space as a whole.
Yeah. Yeah, no, that answers my question. I mean, it is covered call. You're not writing naked calls. You got to own the
Mhm.
underlying. So I understand if you would own the IBIT and writing calls on it, You got to own IBIT, which means an extra, even if it's 25 basis points, you're paying an extra 25 basis points. But by doing it with your own ETFs, there's no double. It's like there's no extra
Yep.
fee. So I get, okay. And then there's the USD conversion cost. So listen, it makes sense to me. I like, the main point I heard is that the liquidity is relatively the same still right now, and it makes sense because it's still Bitcoin, right? It's the
Yeah.
same thing. So okay, it makes sense. So now let's talk about my favorite part, of course, and income investors' favorite, the yield, right? The distribution
Yeah.
yield. So I clearly remember, even though this was like a year ago, a year and a half ago, it's like stuck in my brain. I remember you saying we are confident that in the years to come, you said, you gave years, you didn't give an exact specific time frame, that
Yeah.
we are confident to be able to do double digit yields with the covered call products. And because of the rise of Ether and Bitcoin, I think now we're very close. You just went under 10% yield. So
Mm.
I know you can't say, yes, we're raising the distribution next month, even though I would love for you to say that. I know you're not allowed saying because of regulation, but let me ask it in a different way. What would make you raise or even lower the distributions of BTCY, ETHY? What would make you make that decision? Maybe I could ask it that way. I think you know
Yeah,
what I'm asking.
absolutely. So let me sort of reframe my own comment as well, because I do recall when we talked about this,
Yeah.
I had sort of like anywhere between a 16 to 24-month time frame where I thought double-digit yields would be sustainable before the space got crowded and really implied volatilities were subdued to the point that we won't be able to get that double-digit yield on the maximum 50% overwrite and average of around 35% overwrite that we are doing at any one point in time. So I think it's important to reframe the question within that. Now, as far as what leads to yields being where they are, again, two factors, like you mentioned. One is going to be the price of the underlying, and then the second is going to be the implied volatility, which is, and to put implied volatility in a very easy way to understand is it's how the market prices the expectation of volatility over the next month.
Yeah.
And that's how you price your call options. So that implied volatility, when we had launched our funds for Ether, was trading around 100 to 120%, and for Bitcoin, we're trading around 80 to 100%. Now, I want to put that into context. What do those two numbers mean? The implied volatility for the S&P 500 as a whole trades around 13 to 15%.
The VIX.
That's quite a bit lower, the VIX, exactly. And then the implied volatility for something like an Apple, which is a very safe, stable stock, would trade around 18 to 20%. So, and for Tesla, would trade around 65%.
Yeah.
So these are all just contextual elements that I'm adding to that conversation. And what I want to sort of say is when we launched the funds, the implied volatilities were very, very high, which means we were confident that even with like, an average 35 to 40% override, that we could get to that double-digit yield. Those implied volatilities actually cratered through much of 2023, although they are on the rise right now, just because there is this resurgence of Bitcoin that we're seeing because of the spot ETFs, because of the halving that's going to be happening in April of 2024, as well as the expectation that Ether ETFs might just be around the corner,
Right.
or Ether spot ETFs in the US might just be around the corner. So there is a rise in implied volatility, the expectation of volatility. But through most of 2022, those volatilities were actually traded around the 40 to 60% range for both Bitcoin and Ether, which is quite a bit lower than
Yeah.
historically where they had been, which means that getting that or sustaining those double-digit yields actually became quite difficult. So if you remember, when we were first started writing, we could sort of service 15 to 17 to 18%, and that was working out pretty well. Now those numbers have come down. If we just think about it linearly, it's less than half. The implied volatility is less than half what it used to be. We're still paying out a yield which is just a little bit more than half, because we've been able to sort of figure out how to make the fund more efficient, how to work with more partners, and making sure that we are getting better bids on our implied volatility as well.
Okay.
So I think on a go forward basis, being around 10% will be a sweet spot that we could probably manage for, in the near term. It really depends on how crowded the space gets with the entrance of these new institutional investors in the US spot Bitcoin ETFs. As the space gets more crowded, it'll get more stable. It'll mean less volatility to milk. So that's going to be an important factor. And then lastly, as far as the price of the underlying goes, which defines, how much we pay out on the ETF, which is, a percentage basis, we try and use rolling averages because Bitcoin is a very volatile product, because it can jump from, let's say 35,000 to 45,000 over the course of a month. It doesn't necessarily mean that implied volatilities will be sold at 45,000 that whole month. So, we can't just take a 3.5 cent payout, make it a 4.5 cent payout, for the sake of being sort of linear. We use rolling averages to see, whether or not we've been able to earn enough to pay out enough. What we don't want to do is return people's money to them. What we want to make sure is that they are earning the money that's being paid to them.
A lot of fantastic information and answers a lot of questions. So for sure, I mean, this goes for all covered call products, right? It's not just this.
Yeah.
It really depends on implied volatility. I'm very surprised there was such a big reduction in volatility, but I'm not surprised. As assets mature and they get more boring, there's less volatility. Like an Apple stock, Tesla stock, right? It's a completely big difference. And you actually see that as well in your yield shares, right? Your Tesla yield share is going to have a lot more yield than the Apple stock because there's more volatility. So you answered a lot of questions there. That's great. What would you say is the weight? So I know it's, if the NAV goes up of the fund, it goes up and goes up and goes up, you could probably make more premium, but then there's the implied volatility. Is it like 50? This is just for my curiosity. Like, is it 50-50? Is the implied volatility much more important? So it's like 80 implied volatility, 20 NAV? What would you say on that? How, what's the percentage or approximate percentage these two factors have on the yield or distribution we could expect?
So internally, we use roughly a 3/4, 1/4 rule. So the 3/4 of the importance actually comes from the implied volatility, and about 1/4 of the importance actually comes from the move in the NAV. Now, those implied volatilities, because they're much more volatile, are much more important than actually the price.
I would assume so.
Yeah. So it is not an exact science. It's something that we've come up with after years of managing this fund and being able to sort of like find that sweet spot. Yeah. And so that's why you'll see that, the distribution based on price won't change as often, but the distribution based on how active the space is or how buzzing the space is, which is just another word for how volatile the space is, that will actually be more correlated to any increases or decreases in distribution that you see.
Makes sense. So NAV going up, volatility going up, two great factors that we could say will probably have more of a chance of distribution increases, but the biggest weight is the volatility. Yeah. So that gets me excited because I know both are on the rise. So yeah. I know, let's not say anything, but that's definitely exciting. But thanks for answering these questions. I mean, I had, that 75%, you kind of said, first of all, you said it's not an exact science. So let's be clear. And I try to explain people that, because people get so like happy when they see distributions go up and so disappointed when they go down. They don't even know what they're based on. So it's important to understand what they're based on, NAV and implied volatility. At least now I could kind of put a figure. It's mostly, the majority is the implied volatility, which is what I would expected. So you touch a little bit on the covered call strategy. Let's just reiterate as well. And I think this is the same for even your yield share. So you said a max portfolio coverage of 50%. Normally I see like 30, 35. Yeah. And you do, is that correct for portfolio coverage?
Yeah, so we use a whole bunch of technical indicators to figure out where we're going to be on maximum minimum overwrite. So we have a minimum overwrite percentage of about 50 and a maximum of about 50. We try and do an average of around 35 if we don't really have a strong direction, null view of the market. But as things go right now, so for instance, with Bitcoin now, approached 52,000 the other day, Ethereum approached 3,000 the other day, and this is US dollars.
Yeah.
What we think is we are definitely seeing overbought conditions in the market, and when we do see overbought conditions, we will increase that. So I think
Increase the
currently
calls.
increase the call writing. Sorry. So we should currently, and this is publicly available on the website right now, and be anywhere between 40 and 44% overwritten between the two funds.
Yeah, I do see. I like your website. You actually show the percentage. I really like that. Not all fund managers do that. So I'm constantly on your website to see. And sometimes I see like really, really, really low, but it's because you can't, I think it's because you're constantly updating it every day. And sometimes I guess the call is expired and you got to re-update it
Yeah.
and things. Well, that's pretty cool. I had another question, but I kind of forgot
So
what it was
I'll
going to
just
be,
build
but
on that for a second, and just to,
sure.
just so I think it's important to let our investors know what the strategy behind that call writing is. It's not, we're not
Yeah.
throwing darts in the air. What we're doing is we're using an optimization formula to actually take a look and be very much weighted towards the first 6 weeks of option expiries. And then write option expiries anywhere between 3 and 10% out of the money, depending on what sort of implied volatility bids that we're getting. Now, what that means is we're very much focused on diversification of an option strike plus an option maturity. Those two numbers, what we're trying to do is we diversify as much as possible, because with options, path dependency is very important.
Right.
One Friday, if you're up 10% on a Friday and down 10% on a Monday, you don't want all of your options to be written for that Friday. You want them to be spread out so that you can get, a smoother experience and be able to really pocket that yield rather than just giving up all the upside on a single day. So, how we define our strategy as to where to write, when to mature that writing, that is, I think, the secret sauce behind the success of this.
Yeah, I think it's a good strategy. And I think it's the same for the yield shares. I've talked to Nick about this.
Mhm.
It's. I think you guys have said this the exact same thing. So, and that was going to be my question: the moneyness of the options. So, I think what just like you said, they're typically on average like 3, 4, 5% out of the money on average, but you're writing different legs at different times, right? So it's and I'm just going to share my screen real quick here because I think it's worth showing. So my audience knows exactly what we're talking about. This is the Bitcoin one. If you go to portfolio breakdown, this is what we're talking about here. So covered calls, you see that it's 28.13%. So this is currently, as of this date, you have 28% covered calls on the portfolio, right? And then you could actually see the moneyness of the options here. You see you have 27 options that are active. You could see the duration. Most of them are going to be less than a month because I believe they're 1 month duration, right?
Yep.
And then you actually see the ones where, like right now, it's not surprising to me where 87% of the calls are going to be exercised because of the rapid increase of Bitcoin. And then you see, some are at 4% out of the money. These are 8% out of the money. So this just shows different legs. So I'll say, if you see different legs or different strike prices, when we say different legs, we really mean different strike prices, right? So it's pretty cool. I think you're the only manager that has this. Same thing on the Ethereum. Right now we see 34% coverage. So any comments or anything that we should be looking out for on your website in particular, or did I get that right?
Yeah, no, I think absolutely you have that right. I think one of the things that's sort of important to understand is,
Yeah.
then we talk about the options writing and the percentage. It's important to contextualize it. So, for instance, just here you have short calls expiring. 84% of calls are expiring in less than 1 month, and
Yeah.
then 15% out to 1 month. Now, that 84% should, like when you're thinking about it intuitively, you should be thinking about 84% off the 34%. That's the covered call
Yes.
overwrite
Yes.
percentage, right?
Off of this. Yeah.
So it's not 84% of the fund, it's 84 times 34. So roughly speaking,
Yes.
around 25% of the fund will be, the
Of
economics there
course.
will be against the call options, which are less than 1 month in expiry. So just What I'd also say is there is a couple of days of delay, and I am at slightly higher percentages, but I think we've already mentioned that before. And
Yeah.
the website and what we write, obviously with reporting and everything, there usually is 1 or 2 days of delay.
Yeah, yeah, for sure. And last thing I just want to mention, this was very surprising to me, how currency could have an impact. You have BTCY, that's the hedge the Canadian
Hmm.
dollar, and then you have the dot B, which is non-hedged, and you also have a dot U, I believe, which is just in USD. Same thing for Ether. I was very surprised on how the Canadian dollar doing crappy, which is exactly what's happening now, has such a big effect. Right, you actually see the NAV of the hedged one at 430, and then the non-hedged at 531. That's a big difference. Would this, and I'm pretty sure that the answer is yes, if the US dollar starts getting weaker towards the Canadian dollar, that would technically help the Canadian hedge one, right?
Absolutely,
So,
yeah.
okay, perfect. I have that's what I thought, and I'm hoping that's going to happen when interest rates start getting cut. But that's just another another conversation, another topic. So, last questions I want to ask you now, because we're going for a long time. I know you're busy. You got to write more calls, right? You got the yield shares. You got the Tesla. You got
Mhm.
Apple. You recently launched Microsoft Nvidia. We did a video on it with Nick. Those are all leveraged 25%. Very modest leverage. I would absolutely adore a leveraged version of BTCY, ETHY. Is it something you guys? I know you can't discuss further products, but what are your thoughts on a possibility of putting leverage on this, or is this something you're saying no, we can't, or we because of it's crypto? Is that a thing, or it's something you guys are thinking about? What are your comments on that?
Yeah, so it's a very interesting idea, right? I know Nick has talked to you about 25% as modest leverage and
Yeah,
how that really builds out the total return profile to be very attractive while paying out a very nice distribution.
I love it.
Now, we do think that there is the potential of crypto to be able to do something like that. There's really two challenges, two big challenges that come to making it a reality. One is on the regulatory front.
Could imagine.
As you can imagine, it's
Oh
an
yeah,
open-ended ETF, and if you put a little bit of leverage in there with crypto assets, that's going to be a hurdle to overcome. And on the second side is actually being able to get the leverage that is required, because as you know, most of the leverage providers in this space continue to be the big Canadian banks
yeah,
that we work with, and their ability to provide leverage on an asset such as crypto is still weak is one way of saying it, but nascent is what I would say. It's just
yeah.
because their understanding is still early in the space, and obviously they need to see a lot more maturation of the space before they're comfortable with their risk departments actually being able to give you a loan against crypto assets.
Yeah.
So, once we overcome those hurdles, I think it could be something very interesting for us to take a look into.
Makes sense. A bank, I know the banks are very, very, very conservative for sure. It doesn't surprise me at all. I'm just thinking of it off the bat. Is there any way of doing it without using borrowed money? Is there any way of leveraging maybe 25%, let's say, using options? Is that a thing? This is just my curiosity talking. I don't know if is that possible?
So yes and no.
Okay.
Technically, so the way you would be able to get leverage, that means you want, and you want leverage to the upside. Obviously, you wouldn't want leverage to the downside. So if you wanted leverage to the upside, you'd have to be buying calls. But then we're selling calls to
I get it. Okay.
get the income on the fund. So it's difficult to create that synthetic leverage in this specific model. I'm sure you could come up with slightly fancier ways, and I'm sure your investors also, some of them will be very advanced in their option writing skills, so would be able to come up with creative ways of doing that. It's just within the regulated structure that we do have right now, it is a difficult task.
Makes sense. Makes sense. I appreciate you attempting to answer that. Final question. You got Bitcoin. There's Ethereum. Those are seeming like number one, number two. but once in a while I'll hear of another one. Like I don't really follow the space, to be honest,
Mhm.
but I hear, Solana's coming up as number three. I don't even know what that is, or if it's an Ethereum competitor. I have no idea. Is it possible? Are you guys looking at maybe creating more like a spot Solana ETF, or maybe like an all-in-one type of crypto ETF? Is this, what do you think about that? Is it something Purpose is looking at or thinking about?
So again, there's limited that I can say
Yeah.
about product development. There's a lot of sensitivities around that. But let's put it this way. Purpose's ambitions in the digital space are a lot greater
Okay.
than just a Bitcoin spot and an Ether spot and an Ether yield ETF. I hope we can bring to you and the Canadian investors something that is cool, is interesting, makes a lot of sense, and gives them real view into what the next 10 to 20 years into investing will look like, and just give them further tools to manage their to manage their investing journey for the next 10 to 20 years.
I appreciate that. And make sure you think of us income oriented investors. That's my only ask, my friend. So you pretty much graced us with almost an hour of time. I really, really appreciate it. Hope you come back again on the channel, and I appreciate all the answers. And it was really fun for me, honestly, talking to you about this stuff. Hopefully the audience I know will appreciate it as well. Take care, no one.
Thank you, Adriana. Thank you for having us. And as always, the smart questions, great audience. We
Appreciate
really
it.
like what you're putting together. And audience questions are our best way of understanding and getting feedback as well as to how we can improve, we can be better in serving our Canadian investor client.
I like you guys are always open and honest, always come on the channel, and I wish you and Purpose all the best. Take care, man.
Thank you, Adriana. Bye now.